Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, December 4th. South Koreans briefly stole the political headlines from the French yesterday when their president imposed and then lifted a martial law. But French policymakers will be holding a no confidence vote today that could eventually take Mr. Barnier's government down and inject some volatility to European trading. Then elsewhere, Americans will continue to reveal their latest jobs figures, and OPEC is set to be moving closer to delaying its plans to restore production next year. So tune in. I'm taking you on a world tour. So South Korea briefly stole the light from the French political chaos after the president there suddenly imposed a martial law yesterday, accusing the opposition party, which actually holds the majority in their parliament, of paralyzing his administration. Then he lifted it a few hours later. So the Korean won and the Korean stocks fell. Then they rebounded. Then we saw some volatility in the Asian markets and in cryptocurrencies. But at the end of the day, the impact remained quite limited, and the US and European futures are in the positive at the time I'm talking here, so that France could get back to the front of the scene, with lawmakers there preparing to hold a no confidence vote as soon as today and to take Barnier's government down. Now, you can tell that risk by looking at the CAC 40, which closed 0.26% higher at yesterday's trading session, and at the French 10-year yield, which eased to the lowest level since fall over the last week. But the CAC 40 is set to print its biggest performance gap in the last 3 decades with the German DAX index, and the spread between the 10-year French and German papers has advanced to the highest level since the euro debt crisis of a decade ago. This being said, I am still very much surprised by this mild and a soft market reaction to the French political chaos. After all, France hasn't been stable, politically speaking, since its president Emmanuel Macron called this snap election back in June. I think there could be a mispricing of the French political risk right now, but time will tell. For now, investors look quite relaxed faced with this political chaos and the rising political risk in France. In the US, the sentiment remains cheerful and cozy. At the start of December, the S&P 500 consolidated gains yesterday near its all-time high level, while Nasdaq 100 hit a fresh record. But the Dow Jones Index diverged negatively for the second straight session yesterday. Now, data-wise, the latest figures released in the US yesterday show that the job openings in the US in October rose more than expected by analysts, while optimism rose too, though it rose less than expected. Then, the Federal Reserve's Mary Daly said that there is no certainty that the Fed will be cutting its interest rates this month, but that option remains on the table. You bet it does. Activity on Fed funds futures gives more than 70% chance for another 25 base point cut this month from the FOMC if all goes well. But of course, this week's jobs and next week's inflation data will say the last word about what the Fed should do. So due today, the ADP report from the US is expected to print lower job additions last month compared to a month ago, while the expectation for Friday's NFP number is around 200,000 new non-farm job additions, but a slightly higher unemployment rate and slightly lower wages growth number. Now, soft economic data from the US will have no difficulty at all convincing the Fed those that another 25 base point cut is on its way this month, while a strong-looking set of data from the US could add some suspense to the mix, but eventually the Fed will certainly cut. Because if you look at what happened before, the Fed likes to serve dovish surprises to the market, like a 50 base point cut instead of a 25 base point cut, for example, but refrains from doing the contrary. So you would barely go into a Fed meeting and come out of it with a bad surprise. That's the magic of forward guidance that the Fed follows as a strategy. As such, the US dollar bulls prefer to sit on the sidelines these days until more clarity, and the US dollar index consolidates around the minor 23.6% Fibonacci retracement level on September to November rally. The euro dollar takes this opportunity to catch its breath before another potentially hectic trading session, depending on what the French politicians will decide to do with Mr. Michel Barnier and his government and his ambition to reduce this French budget deficit toward the EU targets and will eventually put it on a more sustainable path. Now, it is very much possible that we don't see a major sell-off in the euro dollar if the French government is taken down, as I believe that possibility must be fully priced in by now. Because some argue actually that the fact that the crisis hits what's called the core countries, like France and Germany, makes it more manageable. I personally wouldn't agree with that, but somehow investors stick around and they don't look that concerned. Therefore, we could eventually see some consolidation and even a minor correction in the euro dollar moving forward in the next few weeks. But note that the pair will remain in the bearish trend below the 106.72 level, which is a major 38.2% Fibonacci retracement on the latest sell-off, justified by the dovish ECB expectations amid the gloomy economic fundamentals in the Eurozone countries, the messy politics in core European countries, and Donald Trump's tariff threats. In Japan, the dollar-yen continues to test the 100-day moving average to the downside, but each attempt to the downside ends with a fresh rebound back to the 150 psychological level. Now, the idea that the Bank of Japan could hike the interest rates one more time before this year ends looks appetizing for the yen bulls, but investors around the world sound unwilling to abandon their carry trade strategy, where you borrow low-yielding currencies like the yen and buy higher-yielding ones to earn that rate differential. And even another rate hike in Japan, wouldn't squeeze the rate differential enough, actually, to force people to walk out of the yen as a funding currency. Now, Bloomberg posted a chart showing the weekly average of 3-month yields implied by currency forwards, and you can actually see there that there is no doubt whatsoever that the yield gap between the yen and their portfolio of higher yielders that apparently includes G10 and EM currencies that yield higher than the yen, which is not difficult to find, is very, very comfortable and will remain very, very comfortable after a potential December interest rate hike from the BOJ. So that means that the Japanese yen's recovery path won't be smooth. And it's actually very good news for the global markets, because the last time the Japanese yen appreciated significantly, and it was during last summer, the global indices were hit heavily, and nobody wants that to happen again. In the energy markets, oil bulls had a good day yesterday. US crude gained more than 2.5% at yesterday's trading session to above $70 per barrel level on news that the US will impose more restrictions on the Iranian oil exports, and also on chatter that OPEC is probably getting closer to delaying its plans to restore production by another 3 months in 2025. So that decision is due tomorrow. The short-term risks remain tilted to the upside, but delaying production will only prevent global oil glut from getting worse, but will not reverse it. So that means that once the geopolitical news and OPEC's decision to delay production restoration is absorbed, the bears will be happy to return to the field. So short-term price rallies are interesting top-selling opportunities for those who believe that the oil prices will continue to go lower, and the bearish trend is valid below the $72.85 per barrel level, which is the major 38.2% retracement on summer sell-off. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market commence. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.